The future of Southwest Florida should scare you. Not because the market's collapsing, but because most people aren't paying attention to what's actually changing. Right now, there are a few massive forces quietly lining up, changes that could completely reshape this market over the next 12 to 24 months. Some of these changes are being talked about, some are barely mentioned at all. But when you connect the dots, the picture looks very different from the headlines screaming, wait or stay on the sidelines. And the scariest part, by the time most people feel confident again, the opportunity window may already be closing. But to understand where South Florida is heading next, we first need to zoom out and look at what's happening at the national level, starting with a $200 billion move that could quietly change mortgage rates across the entire country. Over the last few months, there's been a proposal quietly floating around that hasn't gotten nearly attention it probably should. President Trump has suggested a plan to purchase roughly $200 billion worth of mortgage-backed securities. That might get lost in translation, but this is one of the most direct ways to influence mortgage rates without touching the federal funds rate. Here's why it matters. Mortgage rates aren't set directly by the Fed. They're priced off of mortgage-backed securities, essentially bundles of home loans that investors buy. When demand for those securities goes up, yields go down. And when yields come down, mortgage rates follow. So when you hear about the government stepping in to buy mortgage bonds, what they're really doing is trying to compress the mortgage spreads, narrowing the gap between treasury yields and what homebuyers actually pay. It's similar to what we saw during quantitative easing without officially calling it quantitative easing. Now, to be clear, $200 billion isn't enough to send rates crashing back to pandemic levels, but here's the part most people underestimate. Mortgage rates don't need to collapse for the housing market to react. A 0.5% drop doesn't sound dramatic on paper, but on a typical Southwest Florida home, that can mean hundreds of dollars per month in payment difference. And that's the difference between a buyer waiting and a buyer re-engaging. This is especially important right now because the market isn't suffering from a lack of interest, it's suffering from hesitation. There are millions of buyers across the country, including here in Southwest Florida, who didn't disappear, they just stepped back. And when you give hesitant buyers even a little bit of relief, they don't all rush in at once, but they start paying attention again. Just look at some of the recent headlines where the number of closed sales and pending sales have been increasing month over month. And this mortgage bond proposal doesn't exist in a vacuum, because at the same time this is being discussed, something else is quietly combining with that momentum, and it may be even more important. Over the past several months, the Federal Reserve hasn't officially declared victory, but their tone has changed. We've moved away from aggressive tightening toward a posture that's much more focused on stabilization and eventually easing. And here's the important part most people miss. Mortgage rates don't wait for the Fed to make a formal move. They move in anticipation of what the Fed is likely to do next. That's why we've already seen mortgage rates react multiple times before the official cuts. Not dramatically, but directionally. And in real estate, direction matters more than precision. Buyers don't sit around waiting for the absolute bottom. They move when the math starts to feel reasonable again. When payments stop getting worse, when uncertainty starts to shrink, when the fear of missing out later quietly places the fear of buying too early. That's how buyer psychology actually works. People don't need rates to be low, they just need rates to feel stable. And once that happens, behavior changes. Buyers stop asking, what if rates drop? And start asking, what if prices go back up? That shift doesn't show up in headlines right away. It shows up in showing activity, in offer volume, and in the number of people quietly re-engaging with the market. And this is where Florida becomes very different from a lot of other states, because interest rates are only one lever, and Florida has been pulling another one that could have just as much long-term impact. Florida doesn't just compete on weather or lifestyle, it competes structurally. Right now, there are serious discussions happening around reducing and potentially eliminating property taxes on homesteaded properties. This is huge. It may not sound dramatic at first, but over the life of a home, it's one of the biggest wealth shifts you can imagine. Property taxes are a forever cost. They don't go away when your mortgage gets paid off. They don't care how long you've owned the home. So when a state even talks about reducing that burden for primary residents, it changes the math in a very real way. This isn't a benefit for speculators, and it's not designed for short-term investors. It's aimed directly at people who live here, people who plan to stay, people who want predictability. And that's a key difference between Florida and many high-tax states. In a lot of places, rising home values come with rising tax bills. In Florida, the goal is the opposite, to let homeowners benefit from appreciation without being punished for it. That's why Florida continues to attract people from states where property taxes alone rival a mortgage payment. This isn't just migration driven by sunshine, it's migration driven by policy. But if you live in Florida or you've seriously looked at buying here, you already know that taxes aren't the only cost that matters. There's another one that's been impossible to ignore over the last few years, and it's probably one of the biggest sources of fear in Florida: insurance. Homeowners' insurance premiums jumped. Some carriers left the state. New policies became harder to write. And for a lot of buyers, the insurance payment started to feel just as intimidating as the mortgage. And none of that happened by accident. Florida got hit from multiple angles at once. Storm losses, rising reinsurance costs, and years of litigation that made the market unattractive for insurers. The result was chaos, uncertainty around coverage, uncertainty around pricing, and uncertainty is what freezes buyers. But here's what's changed. The insurance market in Florida is no longer unraveling. It's actually stabilizing. New carriers are entering the state. Some insurers are beginning to adjust rates downward. Underwriting standards are tightening, which actually creates predictability. That doesn't mean insurance is cheap, and it doesn't mean every property looks the same. Homes closer to the water, older construction, and properties in flood zones still require careful planning. And flood insurance is its own conversation. It's highly location specific, elevation matters, construction type matters, and yes, it's still a wild card in coastal areas. But the difference now is this: buyers can model the cost again. They can plan for it, they can underwrite it, and once something becomes predictable, it becomes manageable. And when buyers start feeling confident again, they don't spread out evenly. They gravitate towards places where demand is already strong, where people are still moving, and where long-term fundamentals haven't gone away. And one of the clearest long-term signals in real estate is simple: where people are moving. Florida continues to rank near the top nationally for net in-migration, second only to Texas. And within Florida, Southwest Florida has been one of the regions attracting a disproportionate share of that growth. These aren't short-term renters or tourists. The retirees looking to lock in lifestyle, remote workers bringing salaries from higher cost markets, and equity-rich buyers selling homes up north and relocating with cash. That matters because migration creates durable demand. These buyers aren't timing the market, they're timing their lives. When people move here for lifestyle, taxes, and long-term affordability, they're not making a short-term decision, they're planning to stay. This is why markets with sustained population growth behave differently. They don't collapse easily, they cool, they pause, they reset, and then they move again. But here's the part most people don't see. Even with all this migration, a massive number of buyers and sellers are still on the sidelines. Not because they disappeared, but because they're waiting for clarity. What we're in right now isn't a broken market, it's a pause one. Buyers didn't leave because they stopped wanting homes. They stepped back because rates rose quickly, insurance became uncertain, and the cost of making a mistake felt higher. At the same time, sellers didn't rush to list. A lot of them are still sitting on historically low mortgage rates, and moving would mean giving that up. So instead of activity, you get hesitation on both sides. Buyers wait, sellers wait. And from the outside, it can look like demand just vanished, but it didn't. It just stacked up. This is what creates a coiled market. When even one variable improves, rates ease, insurance stabilizes, confidence returns, activity doesn't creep back, it snaps back. And it doesn't happen evenly. The first buyers back don't get the best prices, they get the best options. That's the part most people misunderstand. The window where you have negotiating leverage usually closes before prices start rising. And that's exactly why many economists are paying close attention to what happens next. Because this kind of setup has historically led to turning points, not crashes. When markets reach this kind of pause, economists tend to watch very specific signals. Not headlines, not sentiment, actual behavior. And what many housing economists are quietly pointing to right now is a possibility of a turning point as we move into spring and summer. That doesn't mean prices suddenly explode. It means transaction volume begins to return, showings pick up, inventory starts to tighten, not because supply disappears, but because demand wakes up. And once that happens, pricing pressure follows. Not overnight, but gradually. This is how most real estate recoveries actually look. They don't feel obvious while they're happening, they feel uncomfortable, because data improves before confidence does. By the time buyers feel safe again, sellers have already adjusted. That's why waiting for confirmation is rarely free. You may get certainty, but you usually give up leverage. And while people debate forecasts and timing, something else has been happening quietly here in Southwest Florida. The region has been rebuilding itself at scale. When you want to understand how confident a region really is, you don't listen to predictions. You look at where billions of dollars are actually being spent. Across Southwest Florida, major infrastructure and development projects haven't slowed down. They've actually accelerated. Lee Health is expanding hospital systems and medical facilities, not just to serve today's population, but to prepare for a much larger one. RSW Airport is undergoing major concourse expansions, increasing capacity and long-term connectivity. Projects like the Kingston development are reshaping entire corridors, combining residential, commercial, and lifestyle components into walkable mixed-use hubs. And places like Cape Coral Yacht Club aren't being patched up. They're being completely reimagined. But one of the most telling signals just happened very recently. Cape Coral officially approved the Seven Islands project along the Burnt Store Marina corridor. This isn't a small development. It's a large-scale, long-term waterfront project designed to transform that entire area over the next decade. And it doesn't stand alone. Cape Coral has also approved a wave of new commercial and retail developments along the Burnt Store Marina corridor. Utilities are now being built out, infrastructure is being upgraded, and what was once considered fringe or underdeveloped is being repositioned for sustained growth. This is how cities quietly change. Not all at once, but through approvals, utilities, and long-range planning that most people don't notice until values have already moved. And this kind of investment doesn't happen in markets expecting decline. Hospitals don't expand for temporary demand. Airports don't add gates for seasonal optimism. Cities don't greenlight massive waterfront projects if they expect population loss. These are multi-year bets. They assume people are coming, they assume jobs are staying, they assume housing demand will remain. And while this kind of development lifts the entire region, the most dramatic changes are still happening in the most limited, most emotional, and most scarce areas of all, right along the water. Because when you combine new infrastructure, utilities, and long-term planning, money doesn't just spread out evenly, it concentrates. And nowhere is that more visible than along the water. If you spend any time in places like Fort Myers Beach, parts of Cape Coral, or older waterfront neighborhoods across Southwest Florida, you've probably noticed the same pattern. Older homes coming down, entire lots being cleared, and in their place, brand new builds that look nothing like what was there before. What used to be modest beach cottages or aging waterfront homes are being replaced with mini mansions and full-scale luxury properties. Not because the old homes were suddenly undesirable, but because the land underneath them became far more valuable. This is what gentrification looks like in coastal markets. It's not driven by flipping, it's driven by scarcity. There's only so much waterfront. You can't make more of it. So when infrastructure improves, cities reinvest, and demand keeps coming, the highest and best use of that land changes. A lot of that capital is coming from the outside regions. Buyers relocating from high-cost markets up north, places where a similar waterfront lifestyle would cost multiples of what it does here. For them, rebuilding makes financial sense. For the market, it raises the floor. Higher replacement costs, higher construction standards, higher long-term values. And this isn't isolated. Once redevelopment starts along the water, it ripples inward. Neighborhoods nearby reprice, tax bases improve, and expectations reset. This isn't decay, it's repositioning. And it leads into one last signal that quietly confirms everything we've talked about so far, and this is the sanity check. Look at the builders. Builders don't operate on hope. They operate on timelines, capital, and risk. Across Southwest Florida, residential and commercial construction is still moving forward. New master plan communities, new multifamily projects, new commercial centers. Now this part matters. When the market slowed, builders did adjust. They reduced prices in certain areas, they offered aggressive incentives, they bought down interest rates. They made it easier for buyers to say yes. And in the process, they made it very difficult for resale homes to compete. But here's the key difference. They didn't stop building. They kept buying land, they kept pulling permits, they kept developing entire communities, all while selling through inventory, even in a slower market. And more recently, something else has started to happen. In certain areas, incentives have begun to shrink. Not because demand disappeared, but because homes are selling at a steady pace. This tells you something important. Builders aren't acting like demand is broken. They're acting like the market reset and they adjusted pricing to match it. That doesn't mean prices go straight up from here. It means the floor is being tested and established. Higher replacement costs still matter. Labor still costs more. Materials still cost more. And those costs quietly support existing home values, even when builders compete aggressively. Builders vote with money. And even after price cuts, incentives, and slower conditions, they're still voting confidently on Southwest Florida. None of this means home prices are about to explode overnight. And it doesn't mean every property is a good buy. What it does mean is that the story being told in headlines doesn't really match what's actually happening on the ground. When you line everything up, interest rates beginning to ease, potential tax advantages, insurance moving from chaos to predictability, sustained migration, billions in infrastructure, waterfront redevelopment, and builders still committing capital, you don't see a market falling apart. You see a market quietly repositioning. And repositioning phases are uncomfortable. They create uncertainty, they create hesitation, and they often reward people who take the time to understand what's really happening before everyone else feels confident. So if you're watching this and you're thinking about making a move, whether that's buying, selling, or relocating to Southwest Florida, or you're simply trying to figure out how these changes might affect your timing, that's usually the point where it helps to talk things through with someone who's actually in this market every day. Not to make a decision, just to understand your options. If you want to have that conversation, you can reach out to me directly at my number below or contact info in the description and the pinned comment. We'll talk through what you're seeing, what you're thinking, and how this market looks right now, not in headlines and not in theory, but on the ground. And if you're not quite ready to reach out yet, if you're still exploring Southwest Florida, or comparing areas, or just trying to understand what relocating here really looks like, I put together a relocation kit that walks you through the things people usually wish they knew sooner, like the areas, the costs, the trade-offs, and what to plan for. You can get that through the QR code on the screen or the description and the pinned comment below as well. Either way, whether you're ready to talk now or you're still gathering information, make sure you're making decisions based on what's actually happening here. And when you're ready, I'm here to help. Thanks for watching, and I'll see you in the next one.